trading psychology is, because the top of the iceberg is what most people see on top of the water. And most people think in order to be a successful trader, you got to do all the right things, right? All the physical things that you see, like, knowing how to read charts, the foundations of trading stocks, the analytics side of things. But in order to be successful, you got to do what people don't see, right? It's master your emotions, learning how to trade with absolutely no emotion. The two biggest emotions that people fall trap to is like greed. That's a big one, and fear, right? A lot of new traders have fear, myself included. Everybody starts somewhere, and fear is just like a learning curve that we got to learn to kind of suppress along the way. Because losing money that we work so hard for is huge, right? And we're here to make money, not lose money. So controlling that is going to be a big deal moving forward. It's a statistics I got from Forbes. It's a really good one. It's 95% of traders fail in the market because they fail to address their trading psychology. Like I said, most people see what's on top of the iceberg. They don't look what's below, and what below is sometimes the most important: how you think and how you control your emotions. And just a question to ask you guys, right? What makes a good trader? Most people are going to say like, oh, this guy's really good at reading charts, right? Oh, this guy's really good at following the news and reacting to the market, or like, this guy's just like, he reads plays so well. But most people won't tell you that, oh, to be a good trader, you need to have great trading psychology, and most traders will have really good trading psychology. We can go ahead and move on to the next slide.
Yeah, and kind of just another thing to add, right? So when it comes to trading psychology, everyone is gonna kind of just have their own way of trading, but it really just depends on kind of what you do as a trader and what kind of plan that you kind of follow. And we'll get into that as we get later into the slides as well.
So just to build off Alex's point, right? Everybody's different. So this slide is about understanding your own trading psychology. The two main things that make up a trader's psychology is their mental and emotional state, right? What you're thinking and what you're feeling. So questions to ask yourself before you start, putting money into the market with inherent risk of losing it is, what is your mental state? Like, what is your expectations going into the market? Are you looking, to make like $100,000 overnight, or hit the lotto basically in the stock market? And why are you trading? Are you trading this for like have a longevity in mind to make a career out of this and make a living out of this, or you try to make some quick money, buy that car you want and just dip out? And these two questions and your mental state will really dictate the way you trade, right? A trader with a mental state of like, I'm going to get rich really quickly, will naturally have a higher risk tolerance, right? They will be a lot more risky, not don't have good risk management, and if you have a mentality of I'm going to get rich quick, you're going to most of the time blow up your portfolio. And that's what I've seen when I've been trading is like, people think that trading stocks is like a rich get rich quick scheme, right? It's not. It's it's very hard, and there's a really big learning curve that you got to get over. So controlling your emotions and um, having the right expectations going into stocks is really important. And as far as emotion goes, reflecting on your emotions, right? Ask yourself a question. Do you have control over fear and greed, which are the two biggest things in the stock market? The fear of losing money, right? The fear of missing out. You see that very often, or even greed. Like, I want more, I want more. And majority of the time, when you have that greed dictate your trades, you're going to lose money majority of the times. And even new traders that come in, right? You ask them, why they taking the trade, and they'll tell you like, oh, I don't know, it's a good feeling, it's a gut feeling, and that's emotion, right? Your gut feeling, and sometimes your intuition when you first start off is an emotion, and we got to understand that emotions come and go. It's a very subjective data, and in the stock market, we want to be as objective as we can, to act off what we see and not what we feel, and that's really important. If you ask a lot of traders, successful traders, right? They trade with no emotion. They could lose 100K or have made 100K, and you couldn't tell a difference off of their facial expressions. And that's what makes a good trader. And the two other emotions that I want to mention is FOMO, which stands for fear of missing out, and regret. These two can really be a downfall of your portfolio, just because, like, like for example, I'll give a lot of people an example. like AMC and GameStop when it made that like historic run. Um, a lot of people made money on that, but more people lost money on that after it ran because people were like, "Oh man, like I regret not getting into it, so I'm going to get into it now." But what goes up must come down, right? So they're losing money on the way down now, and I know like people that are still bag holding AMC and GameStop to this day because they FOMO'd and now they're paying the cost of it. That's a big one. A lot of people FOMO'd that and lost a lot of money, and that's why you got to really get that under control. Or even as we're day trading throughout the day, if you miss a trade, the beauty of the stock market is there will always be opportunities to make money. Don't fear of missing out because that's never going to be a problem. Especially some plays just move extremely fast, and we can't catch every single one. Anything you want to say, Alex?
No, I think you covered everything.
Okay, so this slide can get a little bit confusing, but is controlling your bias, right? Every trader is going to have some type of bias. It's just naturally instilled in us as human beings. Um, Biases are put in us to help us kind of differentiate between certain things. When it comes to the stock market, it can really be our downfall. And most traders oftentimes let bias hinder their trading without even knowing it. Like they have a bias towards certain things and not even knowing that they have a bias towards that thing, which is costing them a lot of money in the long run. There's three most common biases that I'm going to briefly cover, just because we can go into like an hour-long lecture about these. The first one is a negativity bias. This one happens also kind of like in hand with fear, right? So negativity bias are people that are always thinking negative, right? They always think that the stock's going to go down, that we're going to have a crash tomorrow, and that they don't even trust their own place. And this bias can really cost you because you could be leaving a lot of money on the table. It's just like someone with a negativity bias will get into a play that has the potential to do 100%, and they'll sell at 5% because they don't think the trade's going to work out. Right? You're kind of putting a ceiling over yourself and hurting your own potential. The next bias I want to cover, or a fallacy almost, is the gambler's fallacy. What we got to understand about the market, it's nothing like the casino, right? In the casino, you're going to lose money more often than not. In the stock market, you have an opportunity to predict what you think is going to happen. So a gambler's fallacy is like this. It's like a roulette table, right? People got to understand that every single time the wheel spins, there's a new chance and a new opportunity to be something different. A gambler's mindset or a gambler's fallacy is like just because it was red 4 times means that it's going to be red the next. That's not always true because every single time the wheel spins, it has an opportunity to do anything it wants. It doesn't follow a strict, like a linear line where it's like, oh, because it's this, now it has to be that. And this could really hurt someone in the stock market because it's like, you know, um, this stock did this yesterday and the day before, so it has to do this today. Not necessarily, just because there's so much that goes into the stock market that we can't just, use a small sample size to predict these things. And people with a gambler's fallacy will oftentimes fall into that like trap of like, oh, because this happened, now the other thing has to happen. The stock went down yesterday, now it has to go up today. That's not necessarily true because there's so many geopolitical things that really can alter um, the stock market. And the next thing I want to cover is the status quo bias. The status quo basically means that it happened in the past means it has to happen in the future. Um, you know, they always say like the history never repeats but always rhymes, right? These people with a status quo bias will always think that history is going to be the exact same thing every single time because it happened yesterday, it has to happen today, right? And it just doesn't happen like that in the stock market. Every single day is different, right? Every single minute, every single second is different than the second before. We're continuously changing, and people with the status quo bias live in the past, right? They think because it happened, it has to happen again. And sometimes it does. Sometimes it really does in the stock market, right? That's what we use the past to predict the future. But people with a status quo bias fail to adapt to the environment and the status of the market right now, and they're stuck in the past. And like I said earlier, traders would buy it. Traders that have bias don't even know they have a certain bias, and it really affects their trading without them even knowing it in the long run. Anything you want to say about that, Alex?
Yeah, so this is actually something that I kind of had a problem with when I actually first started trading, and I even sometimes do it now. Like, I'll come into the market really with a strong bias, and it actually causes me to lose a lot of money, and I'm sure it definitely causes a lot of other people to lose a lot of money. And one point in particular that I'm really just thinking about was definitely when COVID happened, right? When I pretty much first initially started trading. But everyone's still saying, "Oh, the market's gonna come down, market's gonna come down," and like based on what everyone's saying, right? I literally already have a bias because everyone wants the market to come down, right? So, I would take puts, aka I would kind of imagine that the market wants to go down, and then the next thing you know, that right, markets will come up, and I would actually lose money, right? Because the market doesn't crash overnight, right? It takes weeks or even months for the market to actually even come down. So, right, you can't just place a trade in accordance for only one day, right? And that's literally what I did. And like I said, right, it lost me a lot of money. And one thing that I kind of did to get over that was, like I said, you don't want to come into the markets with a bias, but you want to kind of just pay attention to what's going on within the current trading day, right? You can obviously, yes, you could pay attention to the news and how the markets will react, but you always want to pay attention and trade what's like going on in front of you, right? And that's one thing that I definitely learned about for myself personally is that when I actually stuck to my plan and trade what's strictly in front of me and not really what's going on with the whole entire market, I'll usually be a lot more successful compared to if I have a bias in a particular direction. So, any questions on that? Or I think we're good. Cool.
Um, so now we got all that all the way. This is going to be the slides that you guys really want to pay attention to. Is to basically how to improve your trading psychology. So this is going to be the solutions to all the problems that we just mentioned, right? Um, I feel like risk management is a very like cliche word. People throw that around kind of like as a end all be all, like as the solution to everything. But in your trading psychology, it really is. It's where to start, right? You're working on the things you can work on, which is your risk management. So just things that cover risk management is that will help with your trading psychology. It's like your stop loss level. When to take profits, your trailing stop loss if you need one, and then the indicators and tools that will help you confirm your stop loss or levels. So, what makes risk management so important? Because it's a set of rules, right? It's a set of rules like, oh, I need to stop out at this level or I need to take profits at this level. So, when you have rules set for yourself, it doesn't allow you to use your emotions as much. Because instead of saying, should I sell now? You're going to be like, okay, it's reaching that level where I think it's hitting resistance and I need to sell now. So this is why risk management is so important, right? Or just being like, man, I'm losing money. Do I stop out or should I keep holding? If you have a stop loss level in place, it cancels that emotion out. It cancels out like that greed or like that fear of like, oh man, I'm already down, like whatever. It cancels that out. So I think that's why risk management is so important. And what helps risk management overall is basically your indicators and the tools, right? Um, Tools and indicators aren't like the end all be all of a lot of things. They're just confirmation tool. Like we use them as confirmation to what we see. Like we can use, the fib retracement, for example, to help confirm our support and resistance levels. And through our support and resistance levels, we can use to adjust our stop loss or where we should take profits. So if we have overall good risk management, we should be able to negate all like the mental and emotional factors when it comes into trading, which should make us more successful because we become less emotionless, right? Instead of debating on what to do or what not to do, we have the rules set in front of us and we just follow the rules, and if you follow the rules you will make money. um, the next thing I think might be the biggest thing. It's kind of like a lot of things jumbled together, but it's self-reflection, right? Knowing your limitations. um, before you put money into the stock market that you've worked so hard for, you really want to sit yourself down and know your own limitations, right? Knowing how far you can push yourself. Um, what is your risk tolerance? And even knowing your limitations, like when to walk away, right? The stock market isn't perfect. We're not perfect as human beings. There's going to be days where you're red. There's going to be days when you're really red, and you need to set rules for yourself of when to just walk away. Because walking away is better than forced trades and losing more money. I've seen people blow up accounts in like the most crazy ways because they lost a little bit of money and they try to get it back. They force trades, they end up losing more money, and then they're like, "Man, I'm really in a hole now, so I gotta put my whole portfolio into one trade," and they end up blowing their whole port. You see that very often. Is try to have that get back mentality, and like we said earlier, your mentality going into the stock market is extremely important. And another thing with knowing your limitations is know what you can control versus you can't control. As human beings, we kind of want control over a lot of things, right? And you definitely want control over something that you're putting your hard-earned money into. But the reality of it is that in the stock market, there is more things that we can't control versus the things that we can control, right? What can't we control? We can't control, what the president says, what's happening around the world, the geopolitical scheme, what's happening between Russia and Ukraine. We can't control any of that. We can control what direction the market goes. But you know what we can control though? We can control our emotions. We can control how we act and our planning and switching up the way we trade. And we can control the way we think and the way we feel, right? We can control our emotions, our mentality, which are the two most important things, right? You need to do some self reflecting to know um, what your limitations are so you can become a better trader. Second one is you need to self-reflect on how you can become less emotional, right? Because all the best traders in the world trade emotionless. And a point that comes with that is take losses as they come. Building off that last point I said, like there's so many traders that lose a lot of money, and it's just a part of the game, right? You're going to lose money. We're not going to be perfect every time. Me and Alex, any of our analysts, we're like, I know how hard our analysts work, right? I know how hard they work, but they're not going to be perfect. As humans, we're never going to be perfect. We're going to make mistakes, and we're going to fail in the market. We're going to lose money, but just take losses as they come. Try to be as even keel as you can. Try not to get too low on the losses, and try not to get too high on the wins. Right? Just be as neutral as you can. And then another point is understanding goals and expectations. Understanding that the market is absolutely random. Right? Building off of our last point, we can't control where the market goes, right? We can try to predict it, but we can't control it. And we got to understand that because then we understand that like there's inherent risk in everything that we do. We have to know that there's a risk and we have to acknowledge the risk. And that's how we become a better trader. And one of the biggest points I want to mention, especially for all the new traders in the room that just started, success is not sexy. It's not like you put $100 into the market, make $30,000 back, and go buy your dream car. It's not that. It's the opposite. Success it's taking the stairs up and the elevator down. It's hard work, right? It's waking up at 9:30 every day, sitting on your phone or sitting in front of your computer, and putting in work. And to have a better trading psychology, you need to understand that. You need to understand that this is a long process. It's a journey, right? The goal is to make money, but we have to enjoy the journey, and it's going to be a long, hard journey. If you come into the stock market with the idea of like, oh man, I'm gonna take my $100 to 30K by next week, I can almost guarantee you 99% of the time you're giving the stock market that $100, and you're not making your 30,000.
All right,
Anything you
so
want to say, Alex?
yeah, so I'm just gonna throw out some questions towards you that I'm sure
Yeah.
a lot of people in here um probably have. So I want you to kind of talk about a little bit how we would be able to determine our stop losses and when we would be able to take profits and just the difference between stop losses and trailing stop losses.
Okay. So like I mentioned in that fourth bullet points, indicators and tools, right? That's what we're going to be using to kind of dictate our stop loss and when to take profits. Um, we try to predict the market as best as we can. So we use support and resistance lines. Just to use a trade for an example, just because it makes more sense in my head. Let's say we got a call, right? And for SPY, for example, today, SPY had resistance at 402, right? It has resistance at 402 like all day today. Like it kind of bounced between 400 and 402. If I would have gotten at a call at 400 and rode it up to 402, because I have a resistance level at 402, that's when I should take profits because I'm using my tools to kind of predict where's the best spot to take profits without any more inherent risk than there really is. And that would be where to take profits. Stop loss, for example. Let's say I got in the call at 400, which is support, right? I'm playing the $400 SPY bounce that was happening all day today. Um, I would put my stop loss a little bit below the support. So what does that mean, right? That means if SPY were to break below 400, most chances are it's going to fall to its next support, which might be 396 or 397. I don't have the charts in front of me. But if you put your stop loss right below that support, when it breaks that support, that would be the safest exit that you can exit for a small loss. And by using all that, we're basically using tools and indicators to help kind of confirm these support and resistance levels to help us determine where's the best spot to sell and where's the best spot to stop out. And as far as trailing stop loss, so trailing stop loss is kind of like a stop loss, but it's more there's more motion involved, right? So let's say I'm playing the 400 bounce to 402. Normally, for a trailing stop loss, we won't like play that small of a bounce. It'll usually be like a higher move up. Let's say we're like spies bouncing from 400 to 406, for example. So you're setting your stop loss originally at 400, and then you're just trailing it up as the market moves in the direction that you think it's going to go. Since I'm in a call, right? The stock goes up to 404. I'll put my stop loss at 401 instead of 400. And as it climbs, my stop loss will adjust accordingly as it's going in the direction that I think it's going to go. If that makes sense to everybody, I'm not sure if Alex can explain it in a better way.
Yeah, no, I think that's pretty good. Um, moving to one more question. So we're gonna kind of come back a little bit to the buy section. So if we're looking at something like CPI data, for example, right? So for anyone wondering what that is, that's pretty much just a catalyst event, right? That will have a really strong effect on the market and pretty much how it reacts. So if we see something like CPI, like I'll reference our last CPI data report. And if for those that don't know, CPI stands for Consumer Price Index, and it'll pretty much just give a report on inflation. And so with the last CPI report, overall the data was bad, right? Which initially caused the markets to kind of come down. But even though the data was bad, the market still came up really, really strong. So how do you think that, especially with new traders, when they see data like that come out and they pretty much have a bias and they want to short the market based on the data that's bad, how do you think they could kind of like overcome that and not really lose money based on kind of the event that kind of happened?
So yeah, that's a really good question. So if a new trader came in with that type of bias, so we would say that's under like the status quo bias, right? Just because it happened last time, it needs to happen again this time. But the idea is that it's such a small sample size, right? We have one CPI report before to go off of, which isn't a large sample size as it is. So as new traders and even as experienced traders as a whole, we need to understand that it's so unpredictable with these catalysts, right? The market can move either way. So instead of picking a direction and living and dying with it, we can stay neutral and plan for both sides, right? We can plan like, okay, stock market can either skyrocket or drop. We'll be ready for both, right? So instead of being so reactive to the market, like, oh man, like this happened, I need to go here, you got to be proactive and kind of plan in advance with these big catalysts coming up instead of having that bias in your head, like, oh, because it happened last time, it needs to happen this time. Instead of thinking like that, we can think of like, okay, this happened last time, but if it goes the other way, and if it happens the same way it happened before, I'm ready for it. So that's just a part of becoming proactive as a trader because the stock market's going to be crazy, right? It's going to move, you know, the smallest things can move the market in crazy directions. We just have to be proactive with the market and move with it and not against it.
All right, and then last question. So, when you talk about indicators, how do you recommend just new traders to kind of dive their feet into indicators and kind of just experiment with them within kind of like their trading psychology and how they can incorporate it into like their trades when it comes to determining like stop losses or when to take profits?
Yeah, I gotcha. So indicators at the end of the day, they're just tools, right? And tools are just that. It's stuff to help you with confirm the things you already know. Tools and indicators aren't like the end all be all, right? Just because I see this stochastic cross doesn't mean that the stock is going to move in either direction every single time. Um, and as indicators and tools, we kind of use them as just that. We use them to let's say like validate what we already see. For example, for me, I use three main indicators. I use the stochastic, I use support and resistance lines, and I use a Fibonacci replacement tool to kind of validate my support and resistance lines, right? So when I first see a trade, I'll usually be like, okay, wow, look, I see a head and shoulders right there. And then the next move would be I would be like, okay, it lines up with my support and resistance lines. And then I'd be like, okay, let me do a Fibonacci replacement to see that if my support and resistance lines up with my fib. And if that lines up, I can be like, okay, let me check the stochastics. So like I'm bringing that to you just to give you an example that like just because my one tool says one thing doesn't mean that it's going to happen. I use multiple tools to confirm what I already know. Um, so yeah.
Gotcha. All right, yeah, so I'm gonna kind of say a couple of things about risk management. All right, so what a lot of people kind of do especially when it comes like first comes to trading or when they first start out trading, is that they kind of just dive into a trade just because somebody tells them to get in, right? They don't really kind of have a game plan, which is kind of what we're gonna get into for the next slide. And I feel like what a lot of people also don't do is self-reflection, which is kind of what Don covered, right? So I feel like a lot of people, when it comes to trading and when they lose, is that they trade like the market isn't going to be here tomorrow, right? So the market's always going to be here, whether you're here or not, right? And it's going to constantly move if you're taking a trade or not. So what a lot of people do when they take losses is what's called revenge trading, right? So they'll lose on a trade and they're going to want to try and put more money in that trade, right? So they can make up those losses and also make up gains, right? So revenge trading has a lot to do kind of with your emotions, and you when you do that, you really need to kind of just understand your limitations, right? And that's where it kind of comes into, right? So what I like to do when I'm really having a bad day of trading, if I have like multiple losses within a day, I like to pretty much just take a step back and just stop trading. And it kind of goes back to what Ton said, right? Um, I also like to kind of just look over my trades, right? What did I do wrong and what could I have done differently? Um, was I sticking to my plan? Was I only using particular indicators? Did I have a checklist for kind of just like my confirmations when I was entering this trade? Did I hold too long? So just taking notes of things like that really helps you just understand your personal psychology when it comes to trading, and it'll also kind of help you just stick to your game plan when you're pretty much just creating one and you're looking to enter a trade.
Click it one more time, Alex. Got to get the picture in there. Uh, so me personally, I like to kind of be more lighthearted and add a little bit of humor to stuff. So I developed a system. It's called the P system. Um, what P stands for is PEE. The first step is your planning. Second step is your execute, and then your last step is evaluate. And I'll walk through each one, right? So you're planning. Your planning is what you do all like in the back end stuff, right? It's where the stuff that people don't see. You charting and you putting your support and resistance lines for the market opens, and you kind of just having overall a little bit of knowledge of the market, right? Planning is when you see like, okay, like this could be playing out right now, and you're like, okay, it's reaching support. You know, my plan is to buy it at support, and sell it at resistance, right? Very simple. So that's just the planning of it. And then the executing is actually executing your plan, which could be always be harder said than done. Just because, you plan it and then the market, doesn't line up with your plan always. Like just because you're like, okay, I'm gonna buy support, right? When it's time to execute, maybe it already bounced off of support. So you're getting in a little bit late. Executing is really big because you want to try to execute to your plan as closely as possible, and you need to trust your plan when you're executing. It's always easier when it's set in your head, right? And it's always harder when you have to do it. So when you're executing, you really got to trust yourself and trust what you've been reading and what you've been planning, and just executing your plan. And the next one, I think, is the most important one in my opinion. A lot of traders don't really talk about this and don't do this as much as they should, which is evaluate. Um, a saying that I like to say is you never want to walk away from a trade empty-handed. Whether that be winning or losing, right? You either walk away with money or you're gonna walk away with a lesson, right? You got to learn from your mistakes. In order to be successful, you got to know that there's always room for improvement. And a good way to reflect on that is to evaluate, right? What I like to do, and what Alex said that he does too, is evaluating all your trades. Whether that, even if that trade goes well, there's always something that could have been done better, right? That's how we always grow as a trader. We got to keep improving ourselves because the market's only going to get harder. The market's going to keep changing, and we've got to adapt to the environment that is presented to us, right? So evaluating and looking back is extremely important because it shows you the things you need to work on, and it shows you that even in your good trades, there's room for improvement, and even in your bad trades, when you evaluate it, you can start to like plan out stuff like, okay, I can see a trend here, like every time that I fail a trade, it's because of this, right? And then you kind of develop a trend where you can see it with your eyes and you can be like, okay, I need to do this differently because every time I fail, it's because of this. So that's how you become a better trader and just make your success rate a lot higher, right? It's just to evaluate everything you do because there's always going to be room for improvement. Anything you want to say about that,
Yeah.
Alex?
So I'll just ask you a couple of questions. So when it comes to trading, right? Um, what is your kind of like go-to game plan every single time you look to enter a trade? Like, do you use indicators? Do you wait for like kind of just like a catalyst event, or just what do you use? Do you have like some type of checklist as well? Or
Yeah, so every trader is different. My trading style could differ from our other analysts by a mile. But what I like to do is I have a little checklist in my head, right? And it starts with the P system. Uh, but I like to, just use the knowledge of my market and of the market and all the fundamentals that I know to just kind of scan the market and kind of like look for stuff, right? And if something pops out, then I kind of dive into it and look into it deeper. And like I said in my previous slide, my three favorite tools that I like to use the most are stochastic, support and resistance lines, and then just my Fibonacci replacement. So those are the three tools that I like to use the most, right? On top of like my knowledge of what I know in the market and what I see already. So just to walk through a trade, just because it makes more sense in my head. Let's say I see a bull flag, for example, right? A bull flag is exactly like it sounds. It's a very bullish signal that a stock's most likely going to go up. So I was like, okay, I see something that looks like a bull flag. So I would draw it out, right? And then I would draw my support and resistance lines, and it matches up well with my support and resistance lines. So I check off that list, right? And then I do my Fibonacci replacement to kind of like validate my support and resistance lines, and that checks the box. So I check that list off. And then the next one is like uh, my stochastic, right? And my stochastic is curling up, which is a bullish signal. So I would check that off. So if I can check three boxes off of my tools that I use to kind of confirm my trade, that would be an A+ trade, right? Because the three tools that I like to use the most all checked off. But in order for me to take a trade, I just need two tools to check off, and these tools can differ from anybody, right? Some people don't like to use stochastic. Some people don't like to use fib retracement. For me, that just happened to be my favorite, right? So if two out of the three boxes is check off, for me, that's a trade I would take because that would be like a B plus type of trade. And then if three boxes check off, that would be like an A plus type of trade. If that makes sense to everybody.
Yeah, that makes sense. Um, so when it comes to like your game plan when you're trying to take a trade, especially for new traders when they're trying out like different strategies and everything, do you think it's best for someone to walk away with the trade at break even and kind of just break the rules of their plan? Or do you think it's better for someone to really just take a loss, but they ended up following through with that plan that they had?
Um, Personally, for me, I feel like I would rather take the loss and stick to my plan rather than break even, right? And just cut early. Because if you're breaking to the plan, number one, that tells me that you have conviction in yourself, right? You have belief in your trust yourself, that you put in the work and you think you know what's going on. And if you cut early, you never know if you're going to be right or wrong, right? If you don't let the trade play out and you kind of just cut too early because out of fear, you're never going to know what you did wrong or what you did right. So in my opinion, I would rather take the small loss, 3-4% loss, and learn something extremely valuable from it instead of letting the fear dictate how what I do and how I make my decisions and end up walking away with nothing.
Yeah. So when it comes to also with your plan, how long do you think it's best for especially new traders when they're taking just multiple and multiple losses? How long do you think it should be for them to kind of just rethink their plan or like switch things up?
I wouldn't say switch things up. I would definitely say you should be, like the word refining. I like to use that word a lot. So basically, refining is making it better, right? I think you should be refining your plan after every single trade. Because, right, if we do the P method, um, the evaluate stage, we would be evaluating after every single trade. So after every single trade, we should be like, okay, I did this wrong. Let me refine my plan so I can get the next trade right. You know what I mean? So I think instead of just switching it up and throwing it in the trash saying, man, this plan sucks, um, I think that we should be refining after every single play. And there's always things that we can improve on. So um, I would say stick with the plan and keep refining and keep working on it until it works.
All right. Yeah, I think that something like that definitely has worked for me, right? Um, when I first initially started trading, right, I always consistently changed my plan based on kind of what others were doing, right? When I pretty much first started trading, I really like to watch other people and what they used to do, and I wasn't really creating my own type of plan, and that's really what made me inconsistent, right? Because I didn't understand the strategy or I didn't stick to it, right? I was constantly changing my different strategies or different indicators that I was using to kind of just work what they were using, even though I didn't really understand kind of like their mindset or how they were trading, right? And actually after that, once I actually started implementing my own personal plan, that's when I actually started to be really consistent within the market, right? Because why? Well, I stuck to my plan and what works for me, right? Like Ton said, right? I have my very own checklist. I use my own indicators based on what I like to see when it comes to setups in the market, right? So, and because of that, right? I was able to become really successful after that, right? By kind of just working with what I like to do rather than what others like, right? So yeah, move on from there.
All right. So the next slide is the pyramid, and originally I was gonna put this slide in, but I ended up putting it in because it's so helpful, and there's so much information on the slide that's extremely valuable because it ties so well into our the system that we had before the P plan. Um, so basically, the pyramid kind of goes into more depth of what each one is and the hierarchy of it, right? So at the top of the pyramid, we got execution. I preach execution is so important because you got to execute what you've been planning to do. You know what I mean? A plan is just a plan unless you do something about it. So to read the slide, you execute when opportunity comes that aligns with your system and risk. And down the pyramid, we got creating a system. So this is like the planning phase, right? It's like you create a plan. you're creating a system that works for you, like using certain tools or like using a checklist that you like to do. And this is very important because before you even execute, this is the back end stuff that people don't see, right? This is what makes or break a trade really. Because if you have a flawed plan, you can execute it to perfection, but you're executing a flawed plan, so you're not going to make money on that. So creating a system is also extremely important. And the third one is risk management and emotional management, right? So this one is what we've been talking about all class. It's the trading psychology. It's the stuff that people don't see. It's the stuff that people don't even talk about. But it's really important because it can really turn a good trader into a great trader, right? And it could turn you from doing this for fun to actually making a living out of this. So yeah, risk management and emotional management is extremely important. It also ties in with you know, your risk management could be anywhere from, not taking like how many trades you take a day to, what percentage of your portfolio are you putting per trade. So this pyramid is extremely helpful and it really ties in extremely well with the methods that we've been preaching throughout this whole lecture.
Yeah, so as you can see, right, execution is all the way at the top, your system is in the middle, and risk management is at the bottom, right? So risk management is going to be your base or foundation, right? So without risk management, you're not going to be able to create your system, and you're not going to be able to execute according to your plan, right? If you don't have an execution phase, you're only going to have risk management and only a system, right? And if you're not able to execute within your trade, that's when fear or your emotion comes in, right? And also without execution, it's not going to allow you to kind of just manage your risk management and your emotional management properly.
Okay. And this is our last slide, and I think it's probably one of the most important slides. And I want to leave this message with you guys and kind of like make this a final statement because it's really important, right? One thing you always want to do in the stock market is never stop learning, because you will never know enough, right? You will never be perfect, right? As humans, we're not perfect, but the idea is to always chase perfection, to have 100% win rate, which is hard, but that's the goal, right? And when you never stop learning, that's the best way to overcome all fear or uncertainty that is like that you're having in the stock market, right? When you're learning consistently and you're putting in the hard work, it builds conviction, it builds confidence in yourself. And when you have confidence in yourself, you're taking more trades, right? You're taking trades that you're confident in and you're making money instead of, living in that fearful emotion that like, oh man, I don't know enough, so I can't trade and you'll end up losing money. So that's why learning is so important. And as traders, we are constantly refining our trading systems and ourselves to make us more successful in the market. Um, so learning helps because your system. There's always going to be like room for improvement, right? And we're living in a world where we're making technological advancements like by the minute. Like tools like these stock tools that we have, 30 years ago, they couldn't even dreamt of what we have today. There's going to be new tools coming out every single day. There's going to be more research coming out every single day about what tools is the most, useful and, most efficient. So we got to keep up with the new data, right? We got to keep refining our systems and keep learning so that we can continually adapt to our environment and become the best trader that we can possibly be. And my last point of this lecture is trust what you know and the work that you put in. Um, I know Alex mentors you guys, and I don't talk to you guys as much, but Alex just tells me how much work you guys put in. Um, so trust that, right? Trust what you learn. Trust the hours that you put in. Listening to lectures. Going to Alex's mentorships. Trust that because like that's what's gonna make you successful. And all the learning you've done, you know, you got to put it into use. You got to have conviction in yourself and confidence in yourself, so that you can make money in this market. Because even though it is scary at times to make money and like so much uncertainty going on, you just got to really believe in yourself and believe in your hard work and everything you know. Anything
So,
else you can say,
yeah.
Alex?
So, do you think there's a thing of having too much conviction in yourself when it goes to
No,
trading?
that's definitely a thing as well. Like having too much conviction, because then you're like hopping into trades and then losing money. But like I said, bro, a way you can fix that is by the evaluation method, right? You're evaluating every single trade. Let's say for me personally, I have too much conviction, right? Like as an analyst, and I'm pushing out plays, and I'm like, yeah, guys, this is a plus plus setup. Everybody put your money into it, and then we lose money. Then I would evaluate, and I'd be like, yo, man, what's going on for me to um, lose all these trades? And if I see that it's like my over conviction, then like that's something I know I need to work on, right? But have confidence, it's something that you can fix, but it's definitely like a toxic trait that can really build in the market. But the beauty of the market, because I feel like it will always humble you. It's hard to have too much confidence in the market because you will always get humbled.
Yeah, and I definitely agree with that. But what advice would you really give new traders for the ones that are don't really have as much confidence as like us traders with experience? So how do you think they should kind of come about that so they're able to actually take their own trades like by themselves instead of having to kind of just follow someone or with a guide or something like that?
Yeah, I feel like this is a really important point because I feel like a lot of people get stuck in that novice phase where it's like, okay, they're making money because you're following other people's trades, but you never, kind of blossom past the point of like, becoming into your own and becoming your own trader. And I believe a way to like fix that is, it's gonna sound so boring. Like I said, like success isn't sexy, right? It's gonna sound so boring, but it's just showing up every day. It's logging on the market at 9:30. Just having experience in the market. Seeing what the market does. Because when you see the market enough, things will come slower to you, right? You will start to pick up on things more. And then to build on my next point, it's continual learning. Like you will never learn enough, and you will learn like you if you continue to learn and you continue to just expose yourself to the market and build up that experience, you will build up that confidence to make your own trades. And an extremely important thing I want to leave everybody with is don't be afraid to fail, right? Nobody in this whole Discord is perfect. There's nobody, there might be nobody in the entire stock market that has a 100% success rate for their entire lives. People are going to miss trades and people are going to lose money and people are going to fail. But failing is just a part of not only the stock market, but, life, right? You're going to fail. But I feel like in order to be successful, you need to fail. So, take failure as a lesson, never walk away from a trade empty handed, learn something so that one day, those lessons will pay off, in your bank account and I'll feel so good about it. So that's what I have to say about that.
Yeah, and that's definitely a great point. Like, you definitely want to learn from your trades, right? Whether you're green or red, you could always take notes and just learn from what you did, right? Um, like I said, trading is not easy, right? I've been trading for almost 5 years now, right? And I've only just recently started to get consistent because I've stuck to my plan and stuck to what I'm comfortable with. And I think that's just a lesson with anything that you do in life, right? If you want to be good at something, right, you need to put the work in and you need to just consistently do what you're doing. And you want to just trust the process that you're doing it right. And obviously, right, you got to learn. Um, you could either learn from others, right? Or you could just learn from the things that you do to kind of just help yourself improve for the better and just for the future of what you're focusing on. And yeah, I think we'll end it there. So, anyone have any questions about anything we kind of talked about today?
No, but I just wanted to know how long has he been trading?
Wait, me?
Yeah, yeah.
So I've been trading for, I think since COVID first started, right? So, or a little bit before COVID. So I would say about 4 years. My downfall definitely was inconsistency at first because through the 4 years of trading, I've maybe only
Okay,
had 2 years of consistent trading and like learning and stuff like that.
okay.
All right, cool. Any more questions? Give it about 10 seconds. Then if not, that would actually be the end of this class, but we're actually going to shift gears and we're going to get a little bit more into technical analysis. for the actual market if you guys are interested in that. And we'll actually even cover how we can incorporate our trading plan when it comes to kind of just actually looking at the charts. So just give me 1 second while I load up my charts here. All right, all right, Tom, do you want to kind of cover this part? Or,
Yeah, I'll walk through it with you.
all right, so I'll first do this and then I'll draw it out. Like I said, this is going to be a little bit more of a technical analysis, so people don't really kind of know what's going on with trading. You can kind of just follow along. I guess you kind of just watch, but I'll start us off first. So I'm just gonna give you guys a quick rundown of what we're expecting for the upcoming months, or maybe even upcoming weeks, especially with kind of like how we've been moving recently within the market. So if you guys didn't know, obviously we are currently in a relatively strong downtrend within the market, right? And we know that based on the channel that we're currently trading in, right? So this right here, guys, is called a channel. And pretty much what it is just an area where we just consistently bounce off, right? And we can see that. So we've been in this downtrend channel um, pretty much since last year, just about last year is when we started to downtrend. So we're roughly about December, and that's off of COVID lows, right? So ever since COVID, we had a really nice, strong rally within the market, and ever since then, we've kind of formed a little bit of a pullback. And what we're actually looking for our future actually is that for me personally, I actually am expecting some type of crash within the market, probably within the next couple of weeks or maybe even months, right? So if we actually look at our different time frames, right, we can see that on the daily frame, um, we can see that we're approaching this upper trend line, right? And as we know, when we approach this upper trend line, we always seem to have some type of rejection, right? So if I were to just draw out levels, I could just redo my levels really quick. So I'm just going to draw a couple of levels that we could use for, or as markers for our areas of like trends. So I'll just place these out really quick. Right. Then I'll also make a note at COVID highs. So this is actually going to be a really important note here at these COVID high levels. And also this level kind of around at our 408, 410 level. Right. So if I were to switch to the daily frame and I were to kind of just analyze this, right, we can see that, like I said, overall we are in a downtrend channel, right? And we can see that with our daily frame, we are approaching this upper trend line. So most likely, for me personally, I do think we do have a little bit more room to kind of come up, and especially here with this particular gap fill, right? If you guys don't know, we actually have a gap fill that's right here that we definitely could fill, right? So, and this is actually gonna kind of go into what we were talking about with the psychology class about having multiple confirmations and kind of just sticking to your plan. And as we can see, right, I'm going to be sticking to my plan and I'm going to have multiple confirmations for why I am expecting there to be some type of pullback within the market. So, like I said, first thing that I'm really looking at here is just this gap fill target. And as you guys know, with gap fills, they usually happen, right? So a gap fill is that we'll kind of just fill this gap here within the market to kind of just close this opening range. And with that in mind, as you can see, if we were to fill this gap, we're pretty much approaching right at this upper trend line. Okay, so this upper trend line is roughly about 409 to 408. And as we know, 408 is also a weekly resistance level for us. Um, so moving on from there, we do have a couple of more indicators. So if we actually continue to look right? Recently, we had a really nice bounce from our bottom trend line at 348, which is actually the last CPI report that we had. So we had a bounce at 348 for CPI, and we could see, right, ever since then, we've just continuously gone up within the market. And if you guys actually look really closely, we are actually in kind of a channel, or not a channel, but kind of a rising wedge here within the market, right? So let me just draw this out. We can see that, right, we are getting really tight within the market. And if I were to kind of just stick to the plan when it comes to just drawing out wedges or just flags in general, as a lot of you guys know, what I like to do, I like to actually duplicate the flagpole, right? To give us an idea of our expected move or our targeted move for kind of just the future when it comes to a flag, right? So, like I said, I do want to see some sort of rejection here at this 408 level. Probably maybe even this week. I'm hoping we could probably touch 408 this Friday, or maybe within next week probably. And pretty much from there, I want to see us have a just a relatively strong pullback, right? Because as you know, with the channel, right, we go up and down every single time we touch the upper trend line or we touch the lower trend line, right? So, like I said, I'm referring back to COVID lows as our next touch of um as our next touch for when we have this move down, right? And with a lower trend line or with a downtrend in the market, right? We know it's a downtrend because we constantly create lower highs, right? We're creating lower highs and we're also creating what's called lower lows, right? So we're constantly creating new lower lows. So if we're kind of just referencing this, right? We're approaching this lower high area. So our next expected targeted move, right? It's going to be pretty much all the way down towards lower lows, which for me is going to be right at the top of COVID highs. So after that, I'm going to go back towards this daily frame and I'm going to kind of come back to what I was talking about with kind of just this rising wedge, right? So if you guys didn't know, a rising wedge is a really bearish indicator, right? So when we see this pattern kind of forming, right, we're going to expect another leg towards the downside. And like I said, this is something that I taught a lot with my mentors. But what I like to do when I have a expected target for kind of just the move down, what I like to do, I like to just copy the length of the initial flagpole, and I pretty much just move it towards um, where we're kind of sitting at. So if we look, right, our expected move, it could be either at this 402 area or it could be at this 408. But pretty much from this point on, anywhere from this point on, we can see that if we duplicated our flagpole, our expected move down is going to be actually right at this 339 level, which is going to be our our COVID highs, right? So just from that alone, I already have multiple indicators, right? So we have a lower low, right? So we have a gap fill, so we do want to see a little bit more of a move up, and then I would look to see some type of rejection. We have a rising wedge forming. And another thing that I also like to use is the stochastic slow, which is this one, right? And if we're looking, right, stochastic is currently sitting in the overbought zone, and we can see that the lines are getting tighter, which could indicate that, okay, maybe in the next couple of days or the next week or so, we could actually have a full crossover within the stochastic, which is going to be our indicator that we could see some potential downside. And yeah, Tom, you want to take over?
Yeah, no, I was just gonna say that what Alex would have said right there. Maybe it could be like a lot of like information at once, but it's just like what we discussed in our lecture tonight. It's just the P plan in a nutshell, right? He had a plan. He saw the downtrend in the market, and then he formulated a plan. And his plan was basically like, okay, we're gonna play to the top of the wedge right here until we hit off the resistance, And the plan is that we snipe the top, and then we play it all the way down to COVID highs, right? So that's the plan. And the next part of the process would be just to execute it. And now we just have to basically be patient, to wait for the plays to play out, and then we can execute what we've been planning to do. And just to build on a point, like you know, people think you're gonna come in the stock market and make a lot of money right away, but as you guys see, a lot of these setups take days, sometimes even weeks, to kind of formulate into fruition. So it could be boring. Success isn't sexy, so we really gotta just wait for it to play out. But Alex did a really good job of using multiple tools, like I mentioned before. Like he has a similar checklist to me, like we both use like a stochastic. The only difference is like I really rely on the Fibonacci retracement tool, and then yeah, so he has his own checklist. And to show you, before he even comes up with a conclusion, he did multiple tools and multiple things on his checklist to validate what he was seeing, which was that spies in this little channel right here. And then Alex is going to do the fib retracement to show you like the levels in which spy could go.
Right, so this is one kind of thing that we went over with the mentees, right? If you guys know about the golden pocket, right? When we're looking for areas to short, we always want to start from the top and work our way down, right? As a short level. So as we can see, um, we're sitting right in this golden pocket zone, right? And if you guys know, with the golden pocket zone, we always look for some type of pullback or a bounce, right? And like I said, one of the most common levels for the fib retracement is going to be the 61.8 level. So, right, lines up pretty much perfectly with our fib. So this could actually be just another indicator that we can incorporate with this game plan that we have for the upcoming months. And that'll be it.
Yep.
So,
Anybody have any questions about like what they see or what they're confused about in like this chart? Because I know it could be a lot. Just like looking at this.
I don't have a question, but
what's up?
so basically, since we already hit the golden pocket, would that play already be over since we hit our target area?
Well, remember, this the sense we're expecting, right? Usually when we draw the golden pocket, right? If we start from the bottom to the top, right? We expect to move down and expect to see a bounce, right? But in this case, we're actually trying to short the market, meaning that we want to be able to catch the top and short the market from the top. So if we're starting from the top, right? Or if we're trying to short the top, notice, right, we're in the golden pocket zone, right? So if we're shorting the golden pocket, right, we're pretty much right at the perfect entry level to take long puts for the upcoming months. So since we're here, right, we'll take puts to play this rejection kind of at this upper trend line area.
Yeah. So basically, the Fibonacci is just a tool. It doesn't necessarily means it's always right, but when in use of combination with other tools, the success rate for it is like a lot higher. And the use of Fibonacci really depends on like what you're trying to play, right? In this play, for example, Fibonacci really works for day trades because like you can play the bounces and supports extremely well. For this play, though, me and Alex are gonna. Well, hypothetically, we think is gonna happen is that we fill this gap because the way gaps work in the market is like the stock markets hate gaps, right? So every single gap that's created needs to get filled, and that's just like one of like the things in stock market is like the end all be all. It's like gaps need to fill. So the fact that we have a gap over the top really validates our play that we still have room to go up overhead. And once we fill that gap, it's right at the upper trend line. So if we can catch that upper trend line and ride it all the way down to 340, there's a lot of money to be made there, right? But we just have to execute the plan and just try to snipe the top as best as we can. Because if we do, like, we're going to be making a lot of money if we ride this all the way down.
All right. So does anyone have any questions on that? No? All right. I think we're good. So
All
I
right,
think
thank
we're
you.
pretty much gonna wrap up this class. So appreciate everyone tuning in for this class. This is Ton's first class actually teaching, so I'll let you close this out.
Yeah. I just want to say thank you for everybody that came out tonight. Turnout was definitely bigger than I thought it was, but it was great just to seeing everybody in here because I know I talked to everybody, and this is the first time some of you might like hear my voice for the first time. But I'm extremely thankful for you guys coming out. And tomorrow's Thanksgiving, so I hope everybody has like a really good Thanksgiving with you guys and your families. And there's a lot of things to be thankful for in the stock market, and there's a lot of good things to come. So I look forward to seeing you guys on Friday. Thank you, guys.
All right, cool. Thank you everybody for